Nick, so good to see you. Today
Hey.
we are talking through whether you are taking on too much risk. We have 4 signs that you might be. Risk isn't just about the numbers, it's about how you feel when market conditions change. So let's talk through 4 signs that you may be taking on more risk than you should. Sign number 1, you check your accounts constantly, but how often is too often?
Well, if you're checking your account more than the weather app, that could possibly be a red flag.
Okay.
And sometimes I'll do when I talk with couples, they'll come in and the husband will tell me about this elaborate system that he's running, and the spouse will look over to me and say, "I don't think he's ever going to be able to retire from it because
Yeah.
he's in there every day whenever he's not at work." And so, monthly is understandable. Um, Hourly, that's excessive, right?
Right.
That's anxiety is what that is. That's where you're maybe day trading. That's not necessarily investing. That's not necessarily a strategy.
Right.
So if your investment app is the very first thing in the morning that you're opening up, and that's the last thing that you're checking before you go to bed, I would submit that your portfolio owns you.
Mm,
And you may be taking on too much risk because you're having to keep an eye on it like that.
right.
There's a happy medium between that and creating a strategy or a portfolio or an investment plan that is automated and kind of is a set it and forget it, but keep an eye on it kind of thing,
Right.
where you can just let it work so you can let yourself work in retirement, enjoy
Mhm.
retirement.
Yeah, that should be your job. Good point. All right, next, ask yourself, do you lose sleep when the market drops? That being said, though, Nick, sometimes it's really hard to tune out the noise.
It is. And the real thing that happens is what happens at 2 in the morning. The market drops, and at 2 in the morning, you're kind of turning in bed like, okay, I
Mm,
hope. What are the futures and the stock market futures doing right now? Is it going higher? Is it going lower? How's this affecting me? People don't worry about this in a bull market. When the market's up, they don't worry about it. They don't stress out about it. But and when the markets are calm, everything is good. The problem is when you have a market that drops, and now all of a sudden you start to worry about it, and you start to think, okay, now what do I do? Maybe before you thought, hey, the market's down 20%. Maybe I could handle that. But when you actually see it and how it affects your money, and your money's maybe down 20% or 30%, which is not uncommon for the market to go down like that every 4 to 5 years. And then you look at your portfolio and you think, oh man, that's real money.
yeah,
It's hard to say, but it's only a paper loss. It will come back. And as my dad said, yeah, it will come back. Lincoln came back as a penny, right? So, I mean, I guess in reality it could happen. What I tend to find is that retirement money should not feel like Vegas money.
right.
We were just talking about that off air, that you had a conference in Las Vegas, and people go there and they sit and they try and gamble, but hopefully you're not going there with money that you can't afford to lose,
Right.
and so you'll have a lot of people that tend to maybe lose some money there. So you just don't want, when it comes to these big drops, you just don't want to feel like you're in Vegas. You
Right.
definitely don't want to have a portfolio that feels like heavy metal when you really want smooth jazz, if that makes
Nope, I
sense.
do not like smooth jazz. But to your point, one of the sayings that I really like is investing should be boring. If it's not, it's gambling, right?
Perfect. Love it.
Yeah.
I'm right on board with that. And I think we should come out with a book with that as the title.
Let's do it. All right. Number 3, third sign you may be taking on too much risk. You've made panic driven decisions before. This is known as emotional investing. And the best way to understand what this is like is through the eyes of George Costanza. What does he say, Nick?
If every instinct you have is wrong, then the opposite would have to be right. It's kind of like what we say with contrarian. It's like if, and everybody, how many times have we heard people say, as soon as I buy something, it goes down? And there's this emotional cycle that people go through. Oh my gosh, were you like ready for that one? I think you knew
I'm
right where I
listening
was
to you,
going.
Nick.
Yeah.
Yep.
So you have this cycle where what will happen is people get optimistic, and then they have this elation, this excitement, and this euphoria that the market can only go up in one direction. And that's usually when it's at the peak. And then you have this phase where it starts to go down, and you have denial and anxiety, and then you hang on, you're depressed, you got panic, and then you got despondency. And that's the point when you have the most opportunity, but that's usually the point when people actually sell. So if we look at it like March 2020, um, at the late part of March 2020 after COVID, people were selling out in droves and then never got back in the market. Studies have shown this. Or jumping out of the market after the big October drop in 2008. Heck, I was meeting people that came back in and they said, I never got back in the market because I didn't think it was going to go back up. And then it did. If we look about the dot-com bubble, that was a harder one. Because if you look at that chart, it lasted 3 years. Yeah. Usually a stock market drop is only 4 months. But that one lasted 2000, 2001, into 2022 is when the bottom finally fell. And then it bounced up, but then it came crashing back down in 2008. And that's why if you look at those two numbers there, 2000 to 2008, that's why they call that the lost decade. Because in that period of time, the market actually didn't go up at all. And the problem is not for people working. If people were working, they were probably saving money into it and they were probably okay. They weren't spending their money. But if you take a retiree, if you have this lost decade where the market's going like this and it's actually heading down and then you're pulling money out, that's a bigger problem. Now all of a sudden, it's like having a hole in your pocket. The market's going down, so it's bleeding money, but then you open it up a little bit more because you're pulling money out and that hole in your pocket gets even bigger. And before you know it, you don't have nearly as much money as you thought that you have. So the average investor doesn't get hurt by the market. They get hurt by their reaction to the market.
Right. That is such an important distinction. Good point. All right. Last sign, you feel pressure to chase returns, AKA FOMO.
Well, and how to look at that, parallel back to it real quick. If we were to look at two buckets of money, a red bucket and a green bucket, your red money is your risk money, your green bucket is your safe, protected money. You should actually have monies invested in both.
Of course.
The problem is when the market goes up, people think, I don't need the green money anymore. I'm going to put it all in red. Okay, let's think about that. That would be like going to a roulette wheel and saying,
like
put
roulette.
it all in red.
Yeah.
When you put money in the red bucket, you are giving that money the right to act a certain way. And so when the market goes down, which it will, there's nothing that you, I, or anybody else can do to stop it. That is normal. But when we have 95% of our money, let's say, in the red bucket and the market goes down, because of our allocation, we gave 95% of our money the opportunity to go crazy when the market tantrums. And so what happens, tying this back in with what you said with FOMO, what happens is a lot of people, when the market goes down, balance their portfolios out. They have they've found the reason why they need to have green money because the market went down. So then what they do is they put money in the green bucket and the red bucket when the market's at the bottom, when they should do it the opposite way around. And then what they do is they hear their neighbor talk about, oh, I got all my money in tech. It's doing awesome.
Right.
Or the buddy's talking about crypto, or CNBC's talking about the next big stock market thing. And then what they end up doing is they say, oh, you know what? That green bucket is boring. So let me take all that money and put it over on the other side in the red bucket at the wrong time. And that's how bubbles form. Do you remember Beanie Babies in the 90s?
Of course I remember that. That was a great bubble story.
Yeah, but what happened to that? Everyone wanted one until nobody did.
Right, assuming that they would always just increase in value.
Right, and so chasing returns is the same way. It's like investing because of FOMO, and you're usually buying at the top, and that's tough. So I submit to people and I tell them we need to have a plan that has red money and green money. So the red money has the opportunity to grow if the market goes up, but the green money is going to protect you when the market throws a tantrum. Which
can I share another one of my favorite sayings with you?
What's that?
This is a Wayne Gretzky quote. He said, I don't skate to where the puck is. I skate to where the puck is going to be.
I love it. I love it.
Yeah.
I had a client in just yesterday who's in the auxiliary with the Coast Guard. And he was talking about how many times they will get notifications that people have fallen off of kayaks or whatever in the middle of the ocean. And so when they are going out, they're training themselves that when they go out to find these people, they have to calculate using math, not where the person went in, but where the
Exactly. Right.
current would
Right.
eventually take them by the number of minutes that's elapsed.
Hmm.
I think that's kind of thing is fascinating, just like you said with Wayne Gretzky. I got to go
Yeah.
where the puck is going, not where it was.
Right. Right.
Yeah.
So this bears, it just begs the question, Nick. This conversation is very helpful, but how can working with a financial advisor help us, stick with our portfolio that is in line with our risk tolerance?
You got to create a durable plan that can work in both good and sour markets. End of game, stop. The problem that I'm finding right now, and I can tell this because of the phone calls that we get coming in, is people are trying to be stock jocks. And this usually happens when the market's at the peak. Is they're trying their FOMO. I've heard about this. I've heard about that. I need to invest in this. I need to invest in that. They're getting into this market timing thing because the market's going up. So this FOMO is taking over. And what I see with this when this happens is people are preparing themselves for only one market, a good market, not a sour market. So you got to make sure that you have a durable plan that can both be good in good markets and sour markets. And that plan should have three parts to it. It should separate money into income money that helps, that purpose-driven buckets, let's call it that. And and wow, oh my gosh, we didn't even talk about this before, but man, you just nailed it. So you have your income bucket.
Thank you.
Yeah, this is why you get paid the big bucks. This the income bucket, right? That's going to be your money that's in there that's geared towards income. And then you have your growth money, which is for keeping ahead of inflation. And then your safety money, which is like your money to help you in the near term, to help get you through things. And then that way, if the market's going down, you have your safety money to help you out. You have your income money that's coming in, and you can allow that growth bucket to come back. So you're not risking grocery money in the stock market, is the bottom line. So that's the first thing I would suggest. Second thing that a financial advisor can do is make sure that you're not using emotions over math, that they're doing math over your emotions.
Right.
Making sure your allocations are right, that you have the right amount of money in the green bucket, right amount of money in the red bucket. Not that you're eliminating risk, but you're eliminating how risk can change your lifestyle. And then the third thing I'd look into, or that a financial advisor can do, is really helping create a real retirement blueprint so that when the markets do fall, you don't panic. You just follow the plan. You just refer back to the blueprint, and you just plan, because a stock market drop has been already factored in.
Right.
So just stay with the plan.
Right, right. Yeah, that volatility is already built into the plan, not only,
Right.
predicting that it is coming at some point, but how to capitalize on it when it does happen. So, Nick, if somebody would like to sit down with you to create that plan, that portfolio that is designed around their own very unique risk tolerance, what's the best way to reach you?
Well, I mean, for one thing, I would have make sure people are asking themselves is look at your plan now and just
Hmm.
say, hey, I know it's done really good. So it is for everybody. But then the question I would ask yourself is, how good is my plan if things turn ugly? And really sit down and think about that. And if you don't know the answer, then you probably need to get a stress test because you just want to make sure that your portfolio isn't causing you stress, anxiety, or panic. Those things, that's not investing, that's gambling if you feel that way.
Right,
And the
right,
goal is to take is to take the right risk so that you can sleep well at night. And so we can look at your portfolio, do a stress test, and analyze and see if there's anything that's a red flag that exists. And so people can go to our website, group10financial.com. And when they go there, there is a link where they can get on our calendar for a 15-minute strategy session call, and we can kind of analyze everything and see if there's 5 critical areas that we look at. We're looking at investments, obviously, and income, but we also look at taxes, healthcare, and estate planning. And so we got to look at those 5 critical areas to make sure everybody's okay. And if there's one of those critical areas that you're missing, then that's where we can step in and say, okay, here's how to fix some of those problems.
hmm
So everybody can go to a website, or they can also go and call us at 844 Group 10, and one of our team can set up that 15-minute strategy session call.
Great. Nick, thank you.
Great being with you.